Hello and welcome to another tutorial video. We're going to close out the year this time by talking about debt schedules in financial models and how you can build them using an 80-20 approach that gets around some of the obstacles and problems you often encounter in these types of schedules. So we got a really good question about this topic the other day, which went something like this. I've completed many of your tutorials, but I'm confused about debt schedules. How do I decide on the setup and individual elements? Each example in the three-statement modeling, LBO modeling, and other case studies seems to be different. I am going to answer this question and give you the short version and then go into more extended explanations for each different type of model. But if you want to get all the files and resources, you can go to this URL on screen. I'll also link to it below the video, or you can just Google BIWS debt schedule and you'll get to our knowledge base page, which has many of these referenced files and resources and the new Excel file we're providing here for Netflix. So just go to this URL if you want to see everything in writing, get screenshots, and get the Excel files and slide presentation that we're going through here. A debt schedule tells you how much debt a company is issuing or repaying each year and its approximate interest expense. If a company falls below its minimum cash or targeted cash, then it must issue debt or equity, and this is the fundamental rule that drives almost all types of debt schedules. Now, if a company has a cash flow surplus, meaning that it is well above its minimum cash or targeted cash, then it can use some of its excess cash to repay debt or repurchase stock. What makes it complex is the fact that you can have different types of debt. You can have 5 or 10 or 15 different tranches of debt. They might have different repayment terms. They might have different interest rates. They might have other terms such as penalty fees attached to them, prepayment penalties, original issue discount, things like that. So it can get very complicated if you actually want to do this accurately and show all the different types of debt that a company might have. I would divide debt schedules into 3 main types. The first is for a 3-statement model for a company. The second is for a leveraged buyout or LBO model. And then the third is for a credit or refinancing model or credit or refinancing analysis of a company. In a 3-statement model, where you are projecting the company's income statement, balance sheet, and cash flow statement, I would recommend keeping it very, very simple and just following the outline that I laid out on the previous slide. You generally want to combine all the debt tranches or all the separate issuances of debt into one and use a simple weighted average interest rate. In this scenario, most companies want to keep their cash and debt levels in similar ranges or similar percentages of revenue over time, so it doesn't really benefit you to do something dramatic here to mix things up. If you take a look at our 90-minute 3-statement modeling case study for Otis, which we went through previously on the channel, you'll see a really good example here of a very, very simple debt schedule that does exactly this. Now, the second scenario is for an LBO model, and here you are probably going to need at least 2 tranches of debt. One for term loans or other types of senior debt instruments that can be repaid early, and then another tranche for something like senior notes or subordinated notes or mezzanine that cannot be repaid early. And you might also have a revolver for unmet cash flow needs. For example, if the company needs to borrow extra simply to fulfill some of its mandatory repayments. Normally, in a leveraged buyout scenario, you are assuming that a company repays significant debt over time, so the purpose of this debt schedule is quite different. In a 3-statement model, you are trying to avoid rocking the boat too much, but in an LBO model, you are explicitly assuming that the company repays a lot of its initial debt used to fund the deal over the projection period. In this type of model, you also need to track the interest rate and interest expense for each tranche of debt separately, as well as the repayment terms and all of that. In this tutorial here, we will be going through our Twitter LBO model posted previously on the channel, and I'll be using this to show you how to make some of the calculations. And then the third type of debt schedule here is for a credit or refinancing model. This happens when a company has upcoming debt maturities, or maybe it needs capital for other projects such as growth or international expansion or an acquisition. And so you forecast its financials and you consider different options for the amount of debt and equity to raise. For example, should the company raise 100% debt? Should it raise 100% equity? Should it use a mix of both? Should it use all term loans if it uses debt? Or should it use a mix of term loans and senior notes and subordinated notes? This type of model considers all these alternatives and recommends the best one to the company based on its goals and financial profile. You will need not only the minimum or targeted cash, but you'll also need the targeted credit stats and ratios of the company and also different operational scenarios. Here, with this type of model, the downside cases, the more pessimistic outcomes are very important because typically the upside and base cases are not that interesting because pretty much anything could work. But where it gets interesting is when the company doesn't perform well. And in those cases, often you will have to reduce the amount of debt that it issues or plans to issue. There are other types of debt schedules. For example, on M&A models, debt schedules tend to be quite simple and they follow the three-statement treatment for the most part, where you have maybe just one tranche, maybe two tranches of debt, and it's very simple. You have maybe some low fixed repayment each year and a single interest rate. You also have debt schedules in other types of financial models, such as ones for real estate and project finance and infrastructure, but these are much more specialized and we don't really have time to get into them here, or this would be a 2-hour long video. So that's the short version of debt schedules and what each different type tries to accomplish. If you were to plot all these different types of debt schedules by complexity, the simplest debt schedules tend to be in 30 to 90 minute three-statement models. Once you get into leverage buyout models, they get a little bit more complicated. And then the credit and refinancing models often have the most complex debt schedules, although it does vary a bit. This rule is not universally true. And I have a summary on screen of how these are all different and then how they're the same. One commonality between all of these is that in any type of debt schedule, there's going to be some type of minimum or targeted cash level that drives the schedule or acts as a key driver. The cash flow available for debt repayment is also usually calculated in a pretty similar way. Now, when you get into credit and refinancing models, it's not exactly the same, so it's a little bit less predictable here. But for these first three categories, you almost always calculate this in the same way. And then in terms of the differences, the most obvious one is that the more complex models simply have more tranches of debt that are being tracked separately. Another difference is that the revolver is often not present in very simple and short models, but then when you get into the more complex ones, the revolver is either always there or it is often there, and you could have more complex features like interest rate floors, paid-in-kind interest, cash flow sweeps, original issue discount, commitment fees, and so on and so forth. So this is a quick summary of what to know about debt schedules. We recommend staying somewhere in this range that I've just circled on screen to keep things as easy as possible. So in this tutorial, I'm going to start by going through debt schedules in three-statement models. Then we'll go into an example of a debt schedule in the Twitter LBO model. And then we'll go into an example of a debt schedule in a credit or refinancing model, a simplified version of our model in the main financial modeling course that we offer for Netflix. Let's go to three-statement debt schedules first. The goal here is to keep it very simple because you often have a strict time limit, such as 30, 60, or 90 minutes. For the best example, take a look at the 90-minute three-statement model that we posted in this channel for Otis, the elevator manufacturing company. The overall idea is to take the beginning cash, add everything on the cash flow statement except for debt and equity issuances and repurchases, and then subtract the minimum cash. Let's pull up the Otis file and take a look at what this looks like. So you can see here, I have this excess cash flow line in our assumptions or drivers for the company. And essentially what we're doing is we're actually starting in the balance sheet. We're getting the beginning cash number from right here. Then we are adding up everything on the cash flow statement: cash flow from operations, investing, dividends, dividends to non-controlling interests, FX rate effects. Then we are subtracting the minimum cash balance. And so essentially we're saying this company has to maintain $3 billion of cash at all times. And here's how much they have before that requirement. Let's subtract that $3 billion and see how much they have. They have around 1.6 or 1.7 billion, which means that they can repay some of their debt and they can also repurchase some of their stock. How do we know that it's going to be this percentage, 85% and 15% for the stock repurchases and debt repayment? The company told us, if you look at their investor presentation, see all the documents in that tutorial, but the management team literally tells us that this is what they're planning to do with their excess cash flow. And so we can get to the change in debt and the stock repurchases based on that. Now, if we had the opposite scenario, if we had, say, a cash flow deficit here of 200 million, in this case, the company would issue additional debt. We also project the interest rate here, the average interest expense they're going to pay on the debt, and this in turn goes down and flows into the interest expense shown on the income statement. So this is a very, very simple example of a debt schedule, but it still works quite well, especially when you have almost no time to dig into this in detail. As I say here, when the cash flow available for debt repayment or the excess cash flow or the cash flow surplus or deficit, whatever you want to call it, when this is positive, the company repays some debt and repurchases some stock. When it's negative, it issues additional debt to boost its cash balance. So that's a very simple example, but you can follow it and still do pretty well in these case studies and modeling tests if you understand the fundamentals. Now, the next example we're going to go to here is for the LBO model. And here, the goal is to make it as simple as possible, but no simpler. The requirement here is basically whatever the case study asks you to do. But usually, as I said before, you will need to model at least 2 tranches of debt. So you might have something like term loans, which have mandatory and optional repayments and floating interest rates. In other words, interest rates that change over time. And then for the second tranche, you might have senior notes, subordinated notes, mezzanine, anything that has a fixed interest rate and that has a principal, a balance that stays constant until it matures and needs to be paid back. You might also have a revolver, which is sort of like an overdraft account for a company. If a company runs into cash flow issues because they need to make a mandatory repayment on a term loan, but they don't have enough cash to do it, they can borrow extra. They can draw on the revolver and make some temporary borrowing to afford that payment. For the best examples, take a look at any of the LBO models posted in this channel. Look at the Twitter LBO model that we're going through here. Look at the 60-minute LBO modeling case study. Either of those would work. With this one, people tend to make the most mistakes with the revolver and the cash flow available for debt repayment. The cash flow available for debt repayment is equal to the beginning cash plus the company's free cash flow minus the mandatory debt repayments minus the minimum cash. So let's go in and take a look at this calculation for Twitter right now. I have zeroed out all these formulas in this schedule because I actually want to show you how this works. Let's go over here to the cash flow and revolver calculations, and let's start with cash at the beginning of the period. For this one, we can simply go up to where we have it right at the bottom of the cash flow statement here. So the cash in the beginning of fiscal 2023 is simply the cash at the end of fiscal 2022. So we have that. Now for the free cash flow itself, we just go up and we've calculated it on the cash flow statement. It's just cash flow from operations minus capital expenditures. And then for the amortization, so this is just another word for the mandatory debt repayments. And these are most common with term loans, but you will occasionally see them with some others, such as the margin loan that was used to fund the Twitter leverage buyout. So let's take the amortization here for the term loans, for the margin loan, and then for the unsecured debt, even though it's 0, just to be complete, let's bring it in. And then for the minimum cash, we also need to factor this in. And here, it's just going to be a simple percentage of the company's operating expenses. So let's go all the way up and let's go to cell I-32 right here, the recurring operating expenses. And then let's multiply by the cash as a percent of the operating expenses right here, the minimum cash percent OPEX in cell E45 right there. So we have that. And this should actually not have a negative sign. I want that to be negative right here. We can then add these up and we can copy this across. And although this looks very different, it's basically the same idea or a very similar idea to the one in the 3-statement model. The only difference is that now we have this amortization, these mandatory debt repayments for the term loans and the other types of debt that we didn't have before. But other than that, it's pretty similar. With the revolver, if this cash flow available for debt repayment is negative, we draw on the revolver in this amount. Otherwise, we repay as much of the revolver as possible with the cash flow available for debt repayment. So for this revolver repayments and drawdown formula right here, I'm going to do a check and I'll say that if our cash flow surplus is actually a surplus, in other words, if this is greater than 0, if it's positive, then we take the minimum between this number and then our beginning revolver balance. And this just ensures that if we have 100 in cash flow, but only 50 of revolver left, we only repay the 50 of revolver. That's the point of this minimum function. Now, if we have a deficit or a shortfall here, then we just take this number, we flip the sign on it, and that is our revolver drawdown in this case. So let's copy this over and let's just do a quick demonstration of how this works. So let's say that we have a shortfall of 200 million in the first year. We draw on the revolver until the company can get enough cash. And then in the second period after that, now it has enough that it can actually repay the entire revolver that it drew on initially. And that's how that works. Now, of course, there is more to the schedule than this. There are also optional repayments or a cash flow sweep. The idea here is that if the company has a cash flow surplus after all of this, meaning it doesn't have to draw on its revolver, you can assume some optional repayments. Often it's a fixed percentage. So lenders might say that 50% of their excess cash flow has to go to repay the term loans or other senior debt. This is also known as a 50% cash flow sweep. Other tranches beyond the senior form of debt usually don't allow for this, but you could build in assumptions or some type of switch just in case. So here, if you go down and look at how this works, our cash flow sweep right here, this is based on the assumption that 50% of the company's excess cash flow will be used to repay the term loans and the senior secured notes right here, and 0% will be used to repay the margin loan and the unsecured debt. So in each period, when we have a positive here, we use exactly 50% of that to repay some of these term loans. When this turns negative and we have revolver borrowing, this stops, we draw on the revolver more, and we don't have any optional repayments right here. That is the idea behind an LBO model debt schedule. Let's now go into the last topic and talk about credit and refinancing debt schedules. So the purpose here is a little bit different because it's not about assuming that a company's debt and cash levels stay in the same range or assuming that a lot of debt is repaid. Instead, it's based on the idea that we need to make a recommendation. How much debt should a company issue and how much equity should it issue if it has upcoming debt maturities or an upcoming growth project or something like that? And the constraints could include the minimum or targeted cash, but it could also include things like a maximum debt to EBITDA or a minimum EBITDA to interest. You need the minimum cash, the targeted credit stats and ratios. You need the interest rates, the terms of each tranche of debt, but you also need operational scenarios and you need a way to vary the percent of debt and equity issued and also maybe even the types of debt and equity that are issued. The biggest problem here, the biggest challenge is usually about creating justifiable assumptions and deciding how much to simplify. We are providing a simplified Netflix refinancing model here to illustrate some of these concepts. So if you pull up this link for Netflix, you'll see that it's about 150 or so rows in Excel. This is about 4 times simpler than the actual model in our courses, but it should be a pretty good illustration of the basics of how to set up this type of model. You'll see that I have simplified cash flow projections here, and then I have a debt and equity schedule right below it. So step 1 in this type of model is to build a cash flow projection or the full 3-step model and include multiple scenarios. Now, this is really beyond the scope of this tutorial, but for Netflix at a high level, we assume that in the base case, their memberships grow at a modest rate. In the downside and extreme downside cases, they fall by quite a bit before recovering a little bit. And the same with the revenue per member here. The assumption is that maybe they try out ad-supported tiers or they try out some type of other scheme beyond just paying a monthly fee and it doesn't go well, and so they earn less per member per month after doing all this. The EBITDA margins also tend to be highest in the base case and are quite a bit lower, or at least somewhat lower in the downside and extreme downside cases. And then we also have assumptions for how much they're spending on content per member and the change in working capital, CapEx, acquisitions, D&A, and all the other normal line items that you'd expect on the financial statements. Step 2 is to forecast the interest rates, which is pretty simple if the company mostly has fixed rate issuances, which is the case for Netflix right here. So if we go down to the debt schedule now, you can see that we have a revolver maximum draw. They can only draw on $500 million of the revolver at once. For the interest rates, all these senior notes have fixed rates. So it's pretty easy to forecast these because they're not going to change at all. When these mature, and if the company issues a new set of senior notes, then yes, the interest rate will be different. But until that happens, these interest rates are completely fixed. And then for these others, for the revolver, the new senior notes, and cash equivalents, there isn't really a set method of forecasting these, but you could look up expectations for interest rates and make some estimates based on that. I'm going to paste in our numbers from off screen here just to save some time typing. The basic idea is that at this point in time, interest rates are definitely going up. So the company, if they issue debt midway through this period, yes, they would have to pay a whole lot more than 4 or 5%. They might have to pay more like 8% or 7% on their new issuance. But after that, expectations were that interest rates would fall at least modestly by the end. Once you have the interest rate forecast, you can project the mandatory repayments and maturities so you know the company's cash outflows each year. So I have the schedule down here for Netflix, and it's pretty simple. These 5.5% senior notes mature in the first year, fiscal 2022, and then these others mature in subsequent years. So I will enter zeros right here, and then the formulas are all pretty simple. All we're doing is linking to the last number right here and just copying it across. We could do it for all these. And okay, I didn't do that right. We can do it for these right here. And then we can do it over here. And so you can see what happens, that overall, over time, as more of these maturities come into play, more and more of these tranches of senior notes are paid off as they come due and as the company repays them with its cash, or if the company decides to issue new debt to replace them instead. For the revolver here, so initially this is 0, the new senior notes are 0. Let's link to the old number, and then let's go down And then let's link to the revolver repayments and drawdowns, very similar to what you saw in the LBO model. And then for the new senior notes, let's link to the old number and then link to the additional senior note issuances right here in cell H137. So we have that. And then we can add this up and copy this across. And so that is in place. And let's also finish copying across all these other formulas here. It seems like it didn't copy across correctly the first time, so I just fixed that now. Step 4 is to calculate the cash flow available for debt repayment, or the cash flow surplus or deficit. It's very similar to the approach used in an LBO model. The beginning cash plus the net change in cash, or the free cash flow, minus the debt maturities and repayments, minus the minimum cash. Really, the main difference here is that for credit models, it's not so much about the required repayments, especially because Netflix, this company, doesn't have any term loans. It's more about upcoming maturities, debt that needs to be repaid, and we factor those in. If they had term loans, then we would also include the amortization or the mandatory repayments for them in this formula. So let's go back here and let's start calculating this. So for the cash, the beginning of the period, let's get the beginning cash from the bottom of the cash flow statement or the cash flow projections. We always want to take the ending cash from the period right before this. For the net change in cash before financing, let's go all the way up and let's get our cash flow from operations right here. And then we will add the CapEx and other acquisitions. We're really subtracting it because of the sign. And then we'll also subtract the FX rate and other effects. We're not including anything in here because all of these are going to flow in from our debt schedule. So we don't want to double count these items. We're only factoring in non-debt and equity related line items for this part. That is our free cash flow effectively. And then for the debt maturities here, it's pretty simple. All we do is go up and sum up everything right here. And then we subtract a sum of everything in the column from the year before. And this gives us an idea of how much is maturing in the current year that we're in. And then finally, for the minimum cash for operations. So here, this is going to be a percentage of revenue or expenses. In this case for Netflix, it's the revenue times our percentage assumption here, about 1/6, so 16.7%. We know this number because the management team discloses it and they mention it in their investor documents. And then we can sum these up and then we can copy this across and we have our cash flow surplus or deficit here. And it gives us an idea of how much in stock the company could repurchase, how much in debt it could repay, or how much in additional borrowing it needs to make it through this period. Step 5 is to draw on or repay the revolver, factoring in constraints like the maximum size and also the commitment fees. So here, let's go down and for our beginning revolver, let's link to the ending balance from the previous period. Now for the revolver itself, again, it's a similar formula to what you saw in the LBO model where we take our cash flow surplus or deficit here. If it is positive, then we take the minimum between this number and then our beginning revolver here. If it is not positive, so if it is negative or 0, then we have to go up to the top to the maximum amount that we can draw on. We subtract our beginning revolver right here, and then we compare this to the absolute value of the cash flow surplus or deficit here. This is a rather complicated formula, and we don't really have time to explain it fully here, but essentially, we are enforcing a constraint here and saying that if we have already borrowed 200 million, then we can only borrow 300 million more because the maximum draw is 500 million. So that's that. We can add this up and then we can copy this across. So we have that. So now our revolver is set up. If the company still needs cash, it can now issue equity or debt. If it has a cash flow surplus, it can repay debt or repurchase stock. In this case, we're going to assume that it repurchases stock because that's what the management team told us. They explicitly said that their purpose here, their goal, is to use their excess cash to repurchase stock. So let's go in, and then for the additional senior note issuances, it's pretty simple. We go up and look at our cash flow surplus or deficit. And if this is less than 0, then we need to issue debt. So I'm going to take the cash flow surplus or deficit. I'll add the revolver drawdowns and repayments here because remember, if we draw on the revolver to fund some of this, that means that we don't need to issue as much debt because we've effectively used the revolver drawdown as some of the debt funding right here. And then we will go up and multiply by the percentage that we're assuming. This is currently hidden, so let's copy and paste this formula and expand the grouping so we can actually see this. Let's go up and go to the number right here. We're saying 100% for right now. And then for the last part of this, if we actually have a cash flow surplus here, meaning that this is positive, then we're not going to issue any additional debt. So it's just going to be 0 in that case. Now, for the additional stock issuances, it's going to be very similar. And in fact, I can copy and paste down the same formula. All we do is change the equity percentage here based on our assumption at the top. So we have that. And then for the stock repurchases, we're going to take the maximum between 0 and then the cash flow surplus or deficit plus the revolver repayments and drawdowns right here. Basically, what this formula is doing is saying that if we have some amount of positive cash flow left after all this, after the surplus we had, and then factoring in any repayments we made on the revolver, then we'll use all of it to repurchase stock. And the reason why we're using a maximum 0 here is to handle the case where if we happen to get a negative number here, we obviously don't want to repurchase any stock. Taking the max between 0 and a negative will also always give you 0. So that's why we're setting it up like that there. And then we can copy this across. We can see that in this base case, the company is mostly repurchasing stock now and gets up to a pretty high level by the end. The next step here is to calculate the interest expense and interest income and link everything on the statements or on the cash flow projections. Let's go to the interest expense first, and I'm going to do a sum product function right here. And let's go up to our interest rates where we have them right up here. Let's go down to row 111. And then let's go down and take the balances from the prior period right here down to row 123. So we have our interest expense. And then for the interest income on cash, this is quite simple. We just take our interest rate right here in H112, and then we multiply by the ending cash balance from the previous period. We're avoiding circular references here. And so we're just using simple ending balances from the previous period. So we have that, and then we can copy this across. Now, at this point, something else we should do is link everything on the statements or on the cash flow projections to make sure that our schedule is set up properly. So let's go back up. And you always want to save the linking of the interest expense and interest income until the very end of your model to prevent problems and to make it easier to modify and fix before anything major goes wrong. So let's go down and link to our interest expense and then link to the interest income right below it. And then below that, we want to go in, and for the debt issuances and repayments, we have a couple of things to link to here. So first off, we have the debt maturities, that has to factor in. We also have the revolver repayments and drawdowns, which has to factor in. And then we have the additional senior note issuances right here. For the stock issuances, let's go down and link to our number there. And then stock repurchases, it's right below it. So I could have just copied that formula down, but we'll link to it in row 139. And then for the debt and equity issuance costs and other items, we sort of skipped over this, but you will also factor this in most cases. So row 141 to 142, we'll just do a simple summation, and so we have that. And now we can copy that across. We can also copy across our interest expense and interest income right there. And now we have our debt schedule mostly set up. The last part here is to evaluate the credit stats and ratios in different scenarios until you find a mix of debt and equity that works. You could try different issuance times, different types of debt, other things like that. Here, if we go in and we calculate the debt to EBITDA for this company, let's take the total face value of debt from right here, and then let's go up and divide by the company's EBITDA right up here. And then for the EBITDA to interest expense, let's go up and get the EBITDA right here. And then we can divide by the interest expense right below it. That's probably the easiest thing. And then we'll copy these both over. And you can see I've also created some graphs here at the bottom. So this company has a maximum leverage ratio, a maximum debt to EBITDA of 5x, and then a minimum EBITDA to interest ratio, a minimum interest coverage ratio of 3x. And we can see that in the base case, they're completely fine. There's nothing interesting to say about this. Using 100% debt is clearly okay in this case. If we change the case to the downside case now, first of all, we can see that the additional senior note issuances here are off. I forgot to include a negative sign in front. I also forgot to do it for the additional stock issuances. So let's fix both of those quickly. And now we get a more sane schedule. In this downside case, we're still pretty much fine. We get a little bit lower on the EBITDA to interest, and the debt to EBITDA goes up a little bit higher, but 3 to 3.4x versus a maximum of 5x is fine. There's nothing really to say about that. The problem comes when we go in the extreme downside case, because when we get to this case, you can see the issue pretty well on the graphs. We get to 5.1x debt to EBITDA versus a maximum of 5x. And even with these interest coverage ratios, we definitely get a little bit lower, 4.4x versus 3x. So we're not really in the danger zone with interest yet, but with the debt to EBITDA, we definitely are. One solution here might be to use less debt. So if we use 50% debt and 50% equity instead, we have a little bit more breathing room. Now the debt to EBITDA goes down to 4.8x and we're below the minimum. And the EBITDA to interest ratios here also look quite a bit better. So that might be one solution. We might tell the company something like, if their business is not doing well for a few years, they should consider switching their capital structure mix and using more equity and less debt, fewer senior notes in this case. The bottom line is that if the company's plan is to use 100% debt to fund everything, we'd say that they need to rethink that and probably do something a bit different in these downside cases. In the extreme downside case, if the business is really trending in that direction, we would probably recommend 50% debt, 50% equity instead, and maybe even lower debt, maybe even 25% debt, 75% equity, although we haven't looked at the numbers there. We might also tell the company that rather than doing this, maybe they should just issue equity now to build up a buffer to avoid future issuances at higher rates. Because if they know their maturity profile, if they know, for example, that they're going to have maturities of around $3 billion or so in the last 2 or 3 years of these projections, interest rates are probably going to be higher then, or if not higher, about the same. So why not just issue equity or debt right now or very soon, pay the lower rates that they would get, the 5% or the 6% rather than the 7% or 8%, and take care of it now instead of waiting. So that might be another option to change the timing of this and to not refinance as the maturities come due, but rather to issue more capital upfront. That's about it. So let's do a quick recap and summary now. Debt schedules in 3-statement models can and should be very, very simple. The best example we have is for Otis. The basic idea here is to take into account the company's net change in cash and their minimum cash, take the beginning cash, add that net change in cash, subtract the minimum cash, and if it is a positive number, maybe the company can repay debt or repurchase stock. If it is a negative number, then they will have to issue additional debt. You can assume a very simple interest rate on the debt and use that to get to the interest expense on the income statement. In LBO models, it gets a little bit more complicated because here, the goal is not to keep debt in the same range over time, but rather to assume the company repays significant debt, as you saw with the Twitter model right here. So in this one, the main idea is you still calculate the cash flow surplus or deficit in a similar way, but you also have to factor in the mandatory repayments that the company has, especially on term loans and any other senior form of debt. If they have a cash flow deficit or shortfall, they may have to draw on the revolver. If they have a surplus and they do not need the revolver, then they might be able to make some of these optional repayments, what we call the cash flow sweep right here. And then finally, we conclude with the credit or refinancing model for Netflix. This one follows less of a clear template or clear design, but the overall idea is still quite similar. You need a model with different scenarios and at least cash flow projections. Project the interest rates, the current debt balances and upcoming maturities or other capital needs, calculate the cash flow surplus or deficit in a similar way, draw on the revolver if it's necessary. If not, maybe repay some of the revolver. And then if the company needs more funding after all that, so if the deficit, even after drawing on the revolver, if that is still negative, then they can issue additional debt or additional stock. If this number is positive, then they repurchase stock. Instead, we then calculate the interest expense, the interest income, linked everything on the cash flow projections and looked at the credit stats and ratios and saw how they change in different scenarios. That's about it for this tutorial. Hopefully now you know a little bit more about debt schedules and you have some examples of how they work and how to build them for 3-statement models, LBO models, and also refinancing scenarios.